Welcome back to Bunnex Investment Group. In this video, we are going to talk about a very powerful trading skill that each and every serious trader must acquire. This is actually levels counting, and levels counting is actually the basis of how market structures are formed. So basically, we will start by defining what levels are, and if you have been following this channel for quite a long period of time, you've seen that we use this skill over and over again, and we have been reaping in as much profit as we can. So levels are defined as market impulsive moves after a consolidation or price pullback. We are saying when the market goes to the upside, definitely we'll have a surge in demand or supply depending on the market flow, and that will bring about consolidation or pullback. So these are the manipulative moves available for the market makers to book their profits and accumulate new contracts. So we always say that within the markets there are big fish or the big boys who have large amounts of capital, and when they participate within the markets, we will definitely see the markets actually going to the upside or to the downside depending on their choice. So they are also governed by external authorities, which includes the International Monetary Fund, to name but a few. But when they enter, they either move the market to the upside or to the downside, and whenever they close off their positions, that results in a decrease or increase of supply or demand of that particular asset. So levels exist in all time frames. However, smaller time frames are building blocks of the higher time frames. So to simplify how we count levels, we usually use indicators, and some may favor to trade naked charts, but indicators over the experience that I have been a tool that actually simplifies how we see these structures. So in institutional trading, 5 EMAs are employed, and they are important, and these are the 5 13, 50, 200, and 800. After shooting a video like this, I would see several comments asking for the periods of the indicators that I have mentioned, and these are the ones that you should actually replicate, and they do not need to have a template or anything. You can create these for yourself directly on your phone or on your PC. So the biggest question on this particular topic is how do we count the levels? How to count the levels? So in price action terms, levels are advanced market structure concepts. We are saying we have market structure concept that actually states higher highs and higher lows. So basically, we are saying levels is actually an advanced market structure concept, and from a point of reset, we experience higher highs or higher lows, or vice versa. However, this structure is issued in threes, and a move with 3 impulses is equal to a market maker cycle. So basically, the components of a market maker cycle looks like this, whereby we have what we term the peak formation low, peak formation high, where the cycles are terminated, and within these, between these 2 points, they are connected with levels. And with that in mind, we are saying whenever we break structure, that is only when we validate a level. Therefore, if we are coming out of peak formation low to level 1, for us to validate level 2 flow, we need to break the structure or the high of the first level like that. So we are saying the components of a market maker cycle consist of 3 levels to the upside, and in some cases we'll actually reach level 5, and with that we'll have a different set of rules for that particular cycle. So here is how we are going to simplify levels using the exponential moving averages. We are saying whenever we are counting levels, there are different time frames, and within those different time frames, as I mentioned earlier on, that the smaller time frames are building block of the higher time frames. We are saying whenever we complete a cycle on a smaller time frame, we expect to see a reset. A reset is basically a cycle continuation point whereby we are starting again another cycle. So we usually fight to have 3 cycles or three sets of threes within a higher time frame. So basically, it's actually a concept that is expanded in our one-on-one mentorship as well as training, and you can as well be part of that mentorship by contacting us. You just contact us through our free Telegram channel, which I'll leave in the link down below. All right, so basically we are saying in the first set we have threes that have been issued. After that, those threes, we have another threes that are issued, and then the last threes to be issued. So to connect all these sets, we need what we call resets. So we are saying level 1, we should see a subsequent 1350 EMA cross that is at this particular point. Level 2, a 5200 EMA cross, and level 3 starts as a bounce on the 13 or 50. Then we go to the reset. Then we start again the second set. After reset 1, which is the second set, we will need a 1350 EMA cross, a bounce on the 13, a bounce on the 13 or 50. Then these actually applies on the third set, which is this one, so where we will also need to see a 1350 EMA cross, bounce on the 13, bounce on the 13, like that. So basically, this is how we use the EMAs to simplify our levels. And for you to fully understand, you need to repeat this part as much as possible so that you can be able to apply. Then we also use periods to simplify levels, where we say on H1 time frame a level is a day of rise or a day of drop. On H4 time frame a level is a week of rise or a week of drop. On the daily time frame a level is a month of rise or a month of drop. On the weekly time frame a level is a year of rise or a year of drop. So these are actually tools that can help you to identify the levels and reduce or remove the subjectivity that is within this subject. All right, let's now go to the charts to see examples. Before we do so, please check out our free Telegram channel. I'll leave the link in the description box below. All right, so we are going to use euro against Canadian dollar to illustrate how we count our levels. So basically, whenever you are given any tradable instrument, you need to actually start on the higher time frame, right? On the higher time frame, that is where you see structures and how they are actually forming. In this particular case, I'm on the weekly time frame, which is the highest time frame that I love to use mostly, and I use shapes which are basically rectangles to mark the levels. In this particular case, we can see there was a 1350 EMA cross right at this particular point. My 13 is the one in red, my 50 is the one in blue, and then my 5200 EMA cross occurred at this particular point. Then a retest of the 50 EMA occurred at this particular point. Therefore, I can count the levels, like in this particular case, level 2, then the last level. We've said levels connect to each other using resets. In this particular case, we can see that we had a completed cycle. Therefore, this was peak formation high and this was peak formation low. After peak formation high and peak formation low, depending on the higher time frame, like in this particular case on the monthly time frame, we still need or we still have room to go to the downside. Therefore, on the weekly time frame, we were looking for a reset, which is this one. So a move towards the reset is actually a move where the lower time frame has completed its cycle. So we can see the daily time frame needs to have 3 levels to the upside to reach that reset, or we can even use a Fibonacci retracement level 2 to get that reset point. So at the 61.8, that is where we anticipate to see a reset whenever a cycle has been completed. So in this particular case, we are at the 61.8%, which is also a higher probability point of reset. So we can as well verify if we have 3 levels of the daily time frame to that particular point. We can see that there was a 1350 EMA cross for this impulse, 5200 EMA cross for that impulse, a bounce on the 50 for the last impulse. Therefore, we are at a point of higher probability to reverse to the downside. However, when we see or when we reach a higher time frame peak, there is a probability of seeing a long period of consolidation. We call it level 3 behavior. We can see that at this particular point there was up, down, up, down, up, down. So whenever we are trading within those structures whereby the market is at higher time frame peak points, we need to implement other strategies and other trading methodologies, which we can as well teach you in the one-on-ones. All right, so after that, we are expecting to see this pair to go to the downside due to the levels that we have used to find the buyers. However, did it complete its cycle on the H1 time frame? In this particular case, it hasn't completed. Actually, it has completed its levels to the upside. We can see a 1350 EMA cross, a 5200 EMA cross, a bounce on the 50 EMA, and then a structure which we call a 22 trade pattern. So basically, if we're monitoring this pair, you should be in a sell so that you can get your 50 pips for today, and that will be it. On that note, we have come to the end of our today's video. I'll see you in the next one, and make sure you become part of our free Telegram channel. That note, have a blessed day.